Welcome to the deep dive. Today, we're going to be looking at a really different way of thinking about investing.
Different how?
Well, it's all about using, get this, evolutionary biology to pick stocks.
Okay, that's definitely not something you hear every day.
Yeah, so we're diving into this book. Darwin gave me the investing idea to see how, well, if these ideas about natural selection can help us build a better, portfolio.
Makes sense. Survival of the fittest applied to companies instead of animals, right?
Exactly. And the book, it actually focuses on this investment firm in India, Nalanda Capital, and they've had just incredible returns. I mean, way better than the market.
Impressive. So how do they apply Darwin to investing?
Well, one of the big things is that they really focus on the long term. They're not interested in these like quick flips.
Buy and hold, classic strategy.
Right, but they take it to a whole other level. They almost like form these deep connections with the companies they invest in.
Emotional connections. Isn't that a little risky? I mean,
Uh,
shouldn't investing be all about the numbers?
Well, you'd think so, right? But they actually think this connection helps them stay committed, for the long haul, which they say is like the key to their success.
Interesting. So they're not just looking for companies that are doing well now. They're looking for companies that have uh, that potential to evolve and withstand challenges, just like in nature.
Yeah, like a species that's been around for, I don't know, a million years or something.
Right. Got to be adaptable to survive that long.
Yeah.
So they're basically looking for the corporate equivalent of like a cockroach.
Oh, maybe not a cockroach, but definitely something tough, something resilient.
Got it. So how do they go about finding these super resilient companies?
So they have this whole approach they call the Nalanda way. And it's built on a few key principles. Like the first one is that they are really, really careful about avoiding big risks.
Makes sense. Minimize the downside.
Yeah. And they have this really intense two-level due diligence process. I mean, they really dig deep into the backgrounds of these management teams. They even bring in like forensic experts.
Forensic experts, like financial detectives.
Exactly. So they can, uncover any hidden problems.
Wow, that's serious due diligence.
Yeah.
So it's not just about finding companies with good numbers. It's about making sure the people running them are, well, trustworthy.
Right. And then this is the part that might seem a little crazy. They have this rule, they will only invest in companies that have zero debt.
Zero debt, really. But isn't some debt considered normal? Even healthy for growth?
Yeah, that's what I thought too. But the book makes this really compelling case for like how much strategic flexibility you get when you have a completely clean balance sheet.
I can see that. No creditors breathing down your neck. So
Mm.
you're free to make moves without worrying about those debt payments.
Exactly. And they give this great example about Asian Paints. It's this huge paint company in India.
Hmm?
And during the COVID lockdown when most companies were like struggling to
High
survive,
time, so is.
Asian Paints, they actually gave all their employees raises.
Wait, they gave raises during COVID? How is that even possible?
Because they had no debt, they weren't, tied to all these creditors or having to make these big interest payments.
Wow. That's a powerful example of how playing the long game, even when it comes to your finances, can really pay off. Okay, so they've avoided the big risk, but how do they actually find these high quality, adaptable businesses to invest in?
Well, they use this metric called return on capital employed, ROCE.
ROCE, yeah, I'm familiar with that. It's basically a measure of how efficiently a company uses its capital to generate profit, but how do they use it differently?
So it's not just about, a company having a good year or two. They're looking for companies that have consistently had a high ROCE for a long time.
So it's about showing that sustained ability to generate profits, not just a lucky break or a one-time thing.
Exactly. But doesn't that, make them vulnerable to missing out on these disruptive companies? Like, what about companies that are just starting out? They might not have a stellar ROCE yet.
Yeah, that's a good point. It's like Amazon, for example,
Hmm.
didn't have a great ROCE in its early days.
Right. But they ended up, changing the world.
True. So how do they address that potential blind spot?
Well, they do acknowledge, that there's always that risk of missing out on those outlier companies. But they argue that, on average, this disciplined approach, it helps them avoid a lot more, well, losers.
So it's about sticking to a system you believe in, even if it means making tough choices.
Exactly. It's like a filter, helps you separate the good from the bad.
Okay, so they avoid risky bets, they focus on quality, and they have the patience to, stay the course. But even if you find a company that checks all those boxes, how do you know what price to pay for it?
That's the million-dollar question, right? I mean, valuing businesses, especially when you're taking this long-term view, it's really hard.
Yeah. I mean, traditional methods like looking at price to earnings ratios, they're often based on projections about future performance, which are notoriously unreliable. It's like trying to predict the weather a year in advance.
Exactly. So how do they approach this valuation problem?
They have this really unique method. They focus on what they call backward-looking valuation. They look at the actual historical performance of a business, their track record of making profits, and that's how they figure out what they think is a fair price.
So they're letting the past be their guide to the future.
Exactly. They're saying, forget the crystal ball, let's see what this company has actually done, not what we hope it will do.
That's pretty interesting, but I'm guessing it's not as simple as just like plugging some numbers into a spreadsheet, right?
You're right. It's not that simple. There's a lot of judgment involved. They have to really assess the quality of those past earnings, consider the competition, factor in a whole bunch of other things, and they have to be willing to pay a premium for quality.
So they're not afraid to invest in a company, even if the stock price seems high, as long as they think the underlying business is really strong.
Right. They're looking for those rare gems, the companies that really embody those Darwinian traits, and they're willing to pay a little extra to get them.
So sometimes the best investments aren't the cheapest ones. It's about finding those companies that are truly exceptional and being willing to pay what it takes to own a piece of their success.
Exactly. Now, one thing you hear a lot about long-term investing is that it's, well, too passive. Like you're just sitting there letting fate decide your financial future.
Right. So is Melander really that hands-off with their investments?
Well, they say that their approach is anything but passive. They're constantly monitoring the businesses they own, looking for any changes, any potential problems. They're like gardeners, tending to their plants.
So they're engaged, but in a thoughtful way, not just reacting to every little thing that happens in the market.
Exactly. And this leads to one of the most surprising parts of their approach. They often develop a really strong emotional connection with the companies they invest in.
Hold on, didn't we say investing should be all about the numbers? This doesn't sound very data-driven.
I know, right? But they explain that, while their initial decisions are based on that rigorous analysis, over time, as they really get to know these companies, they start to admire the leadership, the employees, the value they're creating.
So it's about investing in people and in stories, not just in spreadsheets.
Exactly. They're not just buying stocks, they're joining a community. And they argue that this connection is one of the things that helps them stay committed for the long term, through good times and bad.
So it's like finding companies you believe in, companies that are doing good in the world, and then having the patience to let them grow.
Precisely. And that brings up one of the most interesting questions from the book. If most really successful investors rarely sell, and if holding on for a long time can lead to, serious wealth, then why are we all so focused on buying?
That's a really good point. We're all obsessed with finding that next hot stock, but maybe the real key is holding on to the good ones we already have.
Right. But that's obviously easier said than done.
For sure. But that's where the Nalando way comes in, right? It's about finding those exceptional companies and having the guts to stick with them, even when things get a little, bumpy.
It's a different way of thinking about investing, that's for sure.
Definitely.
Yeah, it's definitely a different approach. Requires a lot of, trust. Trust in the process, trust in the companies you choose.
Speaking of trust, one thing that really jumped out at me in the book was this idea of ignoring macroeconomic events.
Yeah.
I mean, how can you just completely tune out what's happening in the world? Don't those global events, sometimes really matter?
Well, I think their point is that we often overestimate the impact of those events, especially in the long run.
So it's not about, burying your head in the sand. It's about recognizing that the market might freak out in the short term, but those reactions don't always reflect, the real value of a company.
Right. They're looking for those really strong businesses, the ones that can handle almost anything.
Mm-hmm.
And those companies, they'll usually prove their worth, no matter what's going on in the economy.
Okay, that makes sense. But what about like industry disruption? When some new technology comes along and changes everything.
Yeah, the Kodak moment, right?
Exactly. How can even the most adaptable companies survive that kind of upheaval?
Well, that's the big question, isn't it? And the book, it doesn't pretend to have all the answers.
So even with all that due diligence, all that careful research, there's still a chance that, the rules of the game could just completely change.
Right. And I think that's where That's where that emotional connection piece comes in again.
Right.
It's not just about the numbers. It's about understanding the culture of the company, the mindset of the leaders, their ability to adapt and innovate.
So it's about finding those companies that have not only survived, for a long time, but have also shown that they can reinvent themselves, evolve with the times.
Exactly. The companies that are always asking, what's next? How do we stay ahead of the curve? Not just trying to hold on to the past.
Okay, I can see how that ties back into their whole, Darwinian investing approach. But honestly, that ignore proximate variables thing, it still feels a little tricky to me.
I get it. It's hard to know, like, what's just a blip, and what's a real sign of trouble.
Yeah, exactly. Like, how do you tell the difference between a bad quarter, which happens, and a company that's, actually going downhill?
Well, that's where the deep understanding of the business really matters. You got to spend time, digging into their history, seeing how they've responded to challenges in the past. It's about seeing the bigger picture, not getting caught up in the day-to-day ups and downs.
So it's about developing that investor's intuition, knowing what to pay attention to and what to ignore.
Right. And it takes time, experience, and you got to be willing to be wrong sometimes.
Nobody's perfect.
Right. Exactly. I mean, they admit in the book that they've made mistakes, missed opportunities, held on to companies too long sometimes. But they believe that overall, their approach has worked out pretty well for them.
It's about trusting the process, even when it gets a little uncomfortable. Now, you mentioned earlier that they almost never invest in turnarounds. Why is that?
Well, they're not saying it's impossible to find a successful turnaround, but it's risky. It's like you're betting that history won't repeat itself.
It's like trying to catch a falling knife, right?
Yeah, exactly. You might get lucky, but you're more likely to get hurt.
So they'd rather bet on the companies that are already, moving in the right direction, the ones that are winning the race, so to speak.
Right. They're not looking for fixer-uppers. They want the companies that are already performing well. And that brings us back to the valuation problem, because those high-quality companies, the ones that are already killing it, well, they're usually not going to be cheap.
You got to pay for quality, as they say. But how do you even begin to figure out a fair price when you're thinking, decades into the future?
They talk about this a lot in the book. Traditional valuation methods, they're often not very useful when you're taking that long-term view. So they focus on something they call intrinsic value.
Intrinsic value, what's that?
It's basically, it's like the core value of the business based on its fundamentals, its assets, its earnings power, its competitive advantages, all that stuff.
So you're trying to see past the current stock price and figure out what the company's really worth, regardless of what the market is doing right now.
Exactly. And they use all sorts of methods to try to figure this out. Financial data, industry analysis, looking at the management team, trying to take into account any long-term trends that might be coming down the pike.
Sounds complicated.
Oh, it is. It takes a lot of judgment and, honestly, a bit of intuition, too. It's not just about the numbers. It's about understanding the story of the company.
So it's like they're not just investors, they're business biographers trying to understand the whole life story of the company.
Exactly. And that deep understanding, that's what gives them the confidence to hold on for the long haul, to ride out those ups and downs.
So it's not just buy and hold, it's buy and understand and then hold on for dear life.
Right. And then there's that emotional connection again.
Yeah.
They really believe in the companies they own. They're not just trying to make a quick buck.
It's like they're adopting these companies into their family, for better or for worse.
Exactly. And that sense of ownership, that connection, that's what allows them to stay the course, to ride out those bumps in the road, and, ultimately come out ahead.
Okay, I'm starting to see how all the pieces fit together, but I have to ask, how do they keep those emotions in check? I mean, doesn't that risk clouding their judgment, making them miss those warning signs?
That's a good point. And they talk about that in the book. They know there's a danger in getting too attached, letting your feelings get in the way of making smart decisions.
It's like falling in love with a stock and then ignoring all the red flags because you don't want to see the bad stuff.
Exactly. But they say it's all about balance, using your head and your heart, combining that careful analysis with, with a good dose of intuition and understanding of the human element.
So you gotta find that sweet spot where data and gut feeling meet.
Right. They call it the Nalanda way. It's a mix of science and art, discipline, and, a little bit of faith.
I like that, the Nalanda way. It's a different way of thinking about investing, that's for sure. But if it's so effective, why don't more people do it this way? Why are we all so obsessed with trying to time the market, find that next hot stock?
I think it comes down to human nature. We want things now, not later. And we hate losing money even more than we love making it.
So it's easier to get sucked into that, that short-term thinking, the daily drama of the market, than to just be patient and let things play out.
Right. And that's where the discipline comes in. It's about fighting those instincts, thinking long term, sticking to your plan even when it feels, well, uncomfortable.
It's about having the guts to be different, to go against the crowd and trust in a different way of doing things.
Exactly. That's what Naland is trying to teach us. It's not just a strategy, it's a philosophy, a way of looking at the world, a way of thinking about our place in it.
That's pretty powerful stuff. It's about learning from nature, from evolution, to become better investors, better
Yeah.
thinkers.
Yeah, it's definitely given me a lot to think about. I mean, so much of the investing world is about, short-term gains, beating the market, all that. It's really interesting to hear someone say, "Hey, slow down, take a breath, think long term."
Yeah.
But this whole emotional connection thing, that still makes me a little nervous,
I get it. It's easy to see how that could go wrong, right? People getting too attached, ignoring the warning signs.
Exactly. I mean, isn't that how those bubbles happen? People getting caught up in the hype and then boom, everything crashes down. Yeah, but remember, they're not saying to just like blindly follow your heart and ignore all the data, all the analysis.
Right. It's about finding that balance, using both your head and your heart.
Exactly. It's a more, I guess you could say, a more holistic approach to investing, one that recognizes, the human element, both
Yeah.
in the companies themselves and in us, the investors.
Okay, that makes sense. But practically speaking, I mean, how do you actually do this long-term patient investing thing? It seems like it would take a lot of discipline.
It definitely does. I mean, especially in today's world, right? Everything's so fast-paced. We're constantly bombarded with information. Everyone's looking for that quick win.
Yeah, it's hard to resist that temptation, that urge to jump on the next hot stock. So how do you stay focused on the long game?
Well, you got to have a really strong sense of like your own investing philosophy. You got to know what you believe in, what your goals are, because when the market is going crazy and everyone's freaking out.
Yeah, it's easy to get swept up in that fear.
Exactly. So you need that internal compass to guide you, to keep you from making, those impulsive decisions you might regret later.
So you're saying it's like, I don't know, like driving through a blizzard. You can't see the road ahead, but you got to trust your gut and keep going, keep moving toward your destination.
Yeah, that's a good analogy.
Yeah.
And that's why they stress the importance of doing your homework, really understanding those businesses you invest in so that when those tough times come.
You have the conviction to stay the course, even when it's scary.
Exactly. You got to believe in those companies, believe that they'll make it through the storm.
It's not just buy and hold, it's buy and understand and then hold on tight no matter what happens.
Right. It's a commitment, not just a quick transaction.
Now, the book, it mostly focuses on, Nalanda's experience in India. But do you think these principles, do they work in other markets too, like here in the US or in Europe?
I think the basic ideas, yeah, they're universal. Focus on quality, avoid big risks, think long term. Those are good ideas no matter where you're investing.
So it's not just about finding, the next Amazon or Google. It's about finding those companies that have those same qualities, that same, I guess you could say, that same DNA, no matter where they are in the world.
Exactly. It's about understanding that real success in business, in life, it usually doesn't happen overnight. It takes time. It takes patience.
It's like planting a tree. You don't expect it to grow into a giant oak tree in a year, right? You got to nurture it, give it time, have faith that it'll reach its full potential.
Right. It's a process, not an event.
Well, this has been a really fascinating deep dive. I got to say, this whole Darwinian investing thing, it's really got me thinking. Maybe I need to rethink my own approach a little bit.
I think a lot of people could benefit from that. I mean, it's so easy to get caught up in the hype, the noise of the market, But the reality is building wealth, real wealth, it takes time, it takes discipline, it takes patience.
It's about playing the long game, not trying to win every hand.
Exactly. And that's what Nalanda is all about. Finding those companies that are built to last, that are going to be around for decades to come, and then just letting them do their thing.
It's a powerful idea. So if you're interested in learning more about this whole Darwinian investing approach, I definitely recommend checking out Darwin Gave Me the Investing Idea. It might just change the way you think about, building your portfolio, building your future. And thanks for joining us on the deep dive. We'll be back next time with another deep dive into the ideas that are shaping our world.